market mechanics. Let me go to the slideshow here. Okay, in this unit, we will be reviewing 3 sections. Section 2.1, the history of mortgage lending. Section 2.2, money markets versus capital markets. And Section 2.3, wholesale versus retail lending. So starting with the history of mortgage lending main events, we can go way back to 1861 when President Lincoln first imposed a federal tax by signing the Revenue Act to fund the Civil War. This was a 3% tax on annual income over $800, and in today's money that would be around $16,000 to $18,000 for annual income. This tax was repealed by Congress in 1907, but then in 1909 Congress passed the 16th Amendment, which reinstituted the federal income tax, sort of as we know it today, and it was ratified in 1913. In the early part of the 19th century, banks were able to call mortgage notes due and payable just because the bank needed the cash. So when the stock market crashed in 1932, depositors rushed to the banks to withdraw their funds, and the banks in turn chose to call mortgage notes due and payable, and many families lost their homes. So by 1933, the Federal Deposit Insurance Corporation was created to promote public confidence and prevent the kind of loss we had in the Great Depression. This insurance provided coverage up to $100,000, although you may know there was a temporary increase from 2008 to 2009 after our own crash, our own recent crash. It increased from $100,000 to $250,000 of insurance. But back to 1934, or in 33, we had the FDIC, and then in 1934, the Securities and Exchange Commission was established in order to enforce the laws and set standards relating to disclosures and other information involving the firms that participated in the stock market. That same year, FHA was established, and FHA's purpose, as you probably know, is to insure mortgages for single and multifamily dwellings, manufactured housing, and even hospitals. The Federal Savings Loan Insurance Corporation was also established that same year. But as many of you know, or may remember, the FSLIC became insolvent in the late 1980s, and the responsibility for the savings and loans shifted to the FDIC. A few years later, 1938, Fannie Mae was created, and its original role was to purchase, hold, or sell FHA-insured loans that had been originated by private lenders. Also, in the late 40s, Fannie Mae was authorized to then start purchasing VA loans. It wasn't until 1965 that HUD was created with the goal of managing national housing and policy programs. As you know, their aim is to strengthen and improve communities and also to enforce fair housing laws. In addition to providing insurance, HUD also provides rehab loans, subsidies, and grants and funding to counseling agencies like yours. In 1968, Fannie Mae privatized, and Ginnie Mae, the Government National Mortgage Association, was created. Fannie Mae then became a shareholder company traded on the New York Stock Exchange, although it did retain its exemptions from state and local taxes. Fannie Mae also retained conditional access to a line of credit from the U.S. Treasury. Ginnie Mae was there to guarantee loans. Also in 1968, the Truth in Lending law was passed. This law is part of Regulation Z, and it requires lenders to clearly disclose the terms of the loan and the true cost of borrowing. It also provided for the right of rescission on some transactions and the fair and timely resolution of credit billing disputes. 2 years later, in 1970, the Fair Credit Reporting Act was passed. This act was designed to regulate the collection, dissemination, and use of consumer information, including credit information. Also in 1970, Freddie Mac, the Federal Home Loan Mortgage Corporation, was established. Freddie Mac was designed to compete with Fannie Mae to facilitate a more robust and efficient secondary market. These government-sponsored entities, as you know them, GSEs, are kind of controversial, or at least there is debate about their role in relationship to the government. Some people would say, however, without them, we wouldn't have the mortgage industry we have today. It was also in 1970 that mortgage pools, private mortgage pools, were created to begin mortgage asset securitizing, the same way Fannie Mae was doing. Okay, on the next slide we keep on with the main events, 5 more main events related to the history of mortgage lending. First, we'll look at the Equal Credit Opportunity Act, part of Regulation B. This act was passed in 1974 and was meant to prevent discrimination against the 7 protected classes: race, color, religion, national origin, sex, marital status, and age. You probably are studying that right now, remembering those 7 protected classes and this act in preparation for the big exam that's coming up. Next we have the Real Estate Settlement Procedures Act, part of Regulation X, created in 1974 to prevent collusion, kickbacks, and that sort of thing. Also required lenders to provide the good faith estimate and the HUD-1. And then the Community Reinvestment Act, passed in 1977, required banks to assist with meeting the needs of low to moderate income communities, reinvest in those communities, and also allowed evaluation of these banks to make sure they're following the law. The Truth in Lending Act was somewhat simplified and reformed in 1980. There were many other revisions over the years to the act, and as you know, we have a new revision right now that you learned about in Pre-Purchase 1, and we'll talk more about later. Then there was, in 1982, the Alternative Mortgage Transaction Parity Act, and this was passed, and it overruled state laws which restricted banks from making anything but conventional fixed-rate mortgages. And this led to the rise of exotic mortgages that were meant for narrow purposes, but which were also abused, and which led to the start of the subprime crisis. Look in your manual starting on page 25 for a deeper review of events that started in 1986 and more details about the subprime crisis. Moving on to section 2.2. Money markets versus capital markets. That starts on page 29 in your manual. Under components of the money market, we start with federal funds. Federal funds are overnight electronic transfers. They're unsecured. They are sometimes referred to as immediately available funds. It kind of works this way. A bank may have deposits on hand for the day that exceed the potential investments goals needed, and the bank can sell its surplus to another bank that doesn't have enough deposits to meet its potential. So both banks benefit, one by meeting its potential and the other by earning interest on the transaction. Deposit accounts are self-explanatory. You know what it means to make a savings or checking deposit, money market deposit, whatever. Bankers' acceptance, not so much self-explanatory. Probably not. You don't run across this so much as a housing counselor. It has some involvement with international funds, involves a bill of exchange for import and export transactions, and may really never be a component of the industry for which you, as a housing counselor, need to be familiar. You will, however, be more familiar and have a more general understanding of stocks and other securities. Securities are any form of ownership that can be traded easily on the secondary market. We're talking about stocks, bonds, and their derivatives, including futures and options and mutual funds. The demand account is basically the same thing as a checking account. And then trade credits are notes issued by a business rather than a bank. It can increase the borrowing capacity than what is available at a bank. And certificates of deposits or certificates of deposit, CDs, are funds deposited into a bank for a set term of time at a set interest rate. You can have, a 6-month CD, 1 year, 5-year CD, whatever. Generally, the longer you wait to get your money, the higher the interest rate. Treasury bills issued by the U.S. government. You can have treasury bills in the short term, such as 3, 6, or 12 months. And these are bills that are worth their face value. For example, you might purchase a T-bill worth $100 for which you paid $50, but when it matures, you are able to cash it in for the $100 value. Under the capital market, you can have treasury bills of longer length rather than the short-term bills. You also have treasury notes. These are 10-year portions of the national debt. Actually, I think it's 2 to 10-year portions of the national debt that are sold in $10,000 increments, and they are guaranteed by the faith and credit of the U.S. government the same way as treasury bills are. Don't think you have to be told much about what real estate mortgage debt is, but maybe you didn't know that the real estate mortgage debt amounts to about 50% of our gross national product. Yeah, the sum of these mortgage loans exceed the combined total of all the other money market instruments that we have. And long-term leasing is a way for businesses to get needed equipment up front at a lower cost. It's very expensive to start a new business, and many wouldn't even get started if they had to purchase their equipment in full. So long-term leasing allows them to have a lower expense in the front anyway, so they can lease the equipment instead of buy it. Bonds in the capital market, they are debt obligations issued by business and government sectors. They have a par value, generally at a minimum of about $1,000. All right, Section 2.3, wholesale versus retail markets. This will take us to page 32 in your manual. Looking at retail markets, first we start with portfolio lenders. A portfolio lender does all the homework, all the loan work. You're doing all the homework. Does all the loan work and keeps the loans in their portfolio. They don't sell them, and often they do their own servicing. Mortgage bankers, on the other hand, do the loan work, but then they do sell to investors. So they do everything the portfolio lender does except keep the loan in their portfolio. The mortgage brokers, as it says there, are the middlemen, basically working on behalf of all their partners, and they're generally originate and process loans, but that's pretty much where their role ends. And then on to wholesale markets. The wholesale lenders, on the other hand, originate loans, but they don't work directly with the customers. Rather, they work with the mortgage brokers and finally the investor here. And the investor has no real contact with the end consumer. They're just there to, that's another vehicle for them for investment. Okay, so you might want to go to page 33 now in your manual and pause the webinar and fill in the boxes on the functions that each player provides. And then come back to the webinar and we'll go through everything together and see how you did there. Okay, we're back, and here's our little chart about who does what. If you look at the portfolio lenders, you would have checked that yes, they take applications and do the processing and commit the funds, disperse the funds, hold the loan for their own investment, and don't sell to investors. They often do their own servicing, but it's possible they could also sell the servicing. And the mortgage bankers, they do all the same things except for holding the loan for investment. They do sell the loan to investors, and they probably do their own servicing. It says here, yes, they definitely do their own servicing. Mortgage brokers, as we said earlier, takes the application, processes the loans, but they don't do any of the other activities: committing funds, dispersing, selling to investors, servicing. Wholesale lenders may possibly do it all under certain subsidiaries. And then the investment or the investors, they don't take application or process the loans or commit funds. They're just holding these loans for investment. Don't do any servicing. So that wraps up the end of Unit 2. Thank you for your attention, and we'll see you the next time.